Now, I have discovered in my trading that there are the 6 best entry points that you can use to enter a stock trade. 3 to go long and 3 to go short. So let's talk about that in this lesson. The 3 best places on the chart to buy a stock are breakouts, pullbacks, and at support when a stock is in a sideways range. And I'll show you examples of each of these so you understand what I'm talking about. A breakout is when a stock takes off in an upward direction. Okay, it can either be on news. Some news has come out that makes the stock go up. It can be on high volume, or both. Now, if it's on volume, there's something you need to understand. Over 90% of the volume in the stock market is based on professional traders, meaning the traders for hedge funds that control billions of dollars. It's not me and you buying 100 shares of stock or even 1,000 shares of stock. It's the hedge fund trader who's trading and buying, 1,000,000 shares of stock. So when we're seeing these charts, we're looking at what the professionals are doing. And right here, when you see this great big volume spike down at the bottom and a big move up, that tells you the professionals are loading up. They like it at these prices based on whatever news just came out, and they're buying. So we want to buy too, because there's a very good chance that they're buying so much because it's a great deal. And in fact, that's exactly what happened here with NVIDIA. And the stock went up quite a bit. It trended after that. And that's what we want. We want to find stocks that trend, that keep going after we buy them. So look at the price action. After the market opened and NVIDIA shot up, well, it shoots up, it kind of goes sideways. It's got a bit of a pullback during the day around lunchtime. And you might notice that it's on relatively low volume, except for that one bar. And then it shot up again and continued the upward trend. So that's pretty typical pattern, actually. A big move up, a little bit of a pullback relative to how big the move up was. So for example, the move up was from here to here. The pullback was about half that distance. So that's pretty typical, pretty strong stock. And then when you see it starting to go back up, these are good buy points. This is a great stock to buy. So a breakout means you're buying it as early as you can after the initial break, as soon as it goes up. So hopefully you're catching it sometime during this green bar. Now, a lot of times that's hard to do, to catch it early. And it happens all the time that I don't see the stock until over here somewhere. So that leads us to the second best place to buy a stock. And it's on the pullback. So this is Apple. And Apple takes off in the morning, and let's say you don't even see it. You see it right there. Well, I don't want to buy a stock, even if I don't know where the pullback's going to be. I don't want to buy it after it's taken off because I know a pullback's coming. I'm going to wait for that pullback. Otherwise, I'll get caught in it after I buy. So the first pullback is a great place to buy. What happens is the buyers who have been buying heavily all this point, they just take a breather. They take a step back, and the sellers jump in because the sellers don't know if the buyers are done buying or if they're just taking a break. So the sellers will push prices back down. And again, the distance down is not very far compared to how far they ran it up. That means there's not much selling pressure. There's still a lot of buying support. So the buyers will let it come down to here, but then they form a wall to just let the sellers sell to them. And a little bit later, they run it up again. So when you see a strong stock pull back and then go sideways, that sideways action means that's a great time to buy. It's very low risk. Okay, so this is between 145 and 150 and 146. So this is a 50-cent range. At most, that's a 25-cent pullback right there. So if you caught it somewhere in the middle, you're only risking a max of 15 cents to make how much? 50, $1, $1.50 or so. 15 cents to make $1.50. That's how you do it. You risk a little to make a lot. So if your entry point is pretty good, once you see that stock pulling back and then going sideways, that's a great time to enter a strong stock and to buy it. It's low risk and high potential reward. Now, the third place that's a best place to buy a stock is at support when the stock is going sideways. The stock is in a sideways range. This is the Spiders ETF. And the Spiders have been going sideways between about 237.75 or 80, just below 238. And the top of the range has been right around 239. Pretty tight $1 range we're in right now. So I want to see the ETF go down to 238 or a little bit below it and then start to head back up. As soon as it starts to head back up, I'm going to buy it because already I think it's at support and I think it's going to keep going up and it's low risk. So that's why I want to buy it there. I mean, it's already bounced off support several times. There's a pretty good chance it's going to do it again. So that gives us a high odds, low risk trade. Now, is there any guarantee, that it's going to go up? No, it could break down through support, drop down to 237. So we still have to adhere to, our risk reward ratios and our stops, but still, it's a good trade to get in. So those were the first 3 best places to enter a trade, and they were all on the buy side. These are the 3 best places to sell short. I didn't put the word short in there, but it's to sell short a trade, to enter position on the sell side. Okay, so it's a mirror image of the 3 buy points. Instead of a breakout that goes up, we're going to have a breakdown or a big move of prices going down. And instead of a pullback, a stock goes up and then pulls back and then goes up again. It's the exact opposite. Stock goes down, it bounces up, starts to head down again, boom. That's where you want to sell it short right there. Low risk place. If it starts to go up above the highest little short-term point that you just passed, you get out with a small loss. Okay, and then instead of sideways range, you buying at support, you can sell short at the top at resistance as well. So let's take a look at those trades. So this is Merck. Look at that candle. Definitely that's some kind of news. It could be bad earnings report or it could be some other news. So what happens is you got a big down move on heavy volume. Once again, the professionals are getting out en masse in huge volume. So this volume bar is at least 2 times these other volume bars. Okay, maybe even 3 times or almost 3 times. So what happens is you don't know where the stock is going to bounce. So if you don't catch it up here, you don't see it coming, you wait. You don't jump in or else it could bounce on you just after you get in and you'll lose money. So you wait for the bounce. Then when it starts to go down again, right about here is where I want to enter a short trade. And then it goes down, and when it starts to bounce again, that's where I want to get out. So that's my intraday trade. Now I might do it again. If I see the stock come up here and start to come down, I might short it there and make a little bit, or it comes up here and starts to go down and short it there and make it money down to here. That's kind of the entry and exit points we want to look for intraday as day traders. So that's a breakdown So we can catch it here for a breakdown, or if we do the bounce move, we'll enter it right there. So there's the bounce, and we'd, like I said, we'd enter it right about there. Now here's the other thing. When the spiders are going sideways, just like in the previous example, instead of buying down here at support, we're going to sell the stock or the ETF up here around 239, and then we'll enter it short up here to make money on the downside again. So that's how you do it. Those are the 6 entry points, 3 long and 3 short. By the way, you don't want to enter a trade in most cases until it starts to go in the direction that you're expecting. You want the stock to kind of show you that it's heading the direction you expected, and then you jump on. Now, it's a real professional move to jump in at resistance or support when the stock is still going the opposite direction. That's pretty dangerous. I recommend you stay away from that until you get more experience. Wait for the stock to start to head in the direction you were anticipating, and then enter your trade, long or short. So to review, the 3 best entry points long are breakouts, pullbacks, and at support when the stock or ETF is in a sideways range. The best short entry points are breakdowns, bounces, and the top of a sideways range. So these are, again, the 3 mirror images on the downside of the 3 buy points on the upside. You may need to review this video, this lesson, over and over. Make sure you get it down, because this is going to help you a lot to know this one. So go ahead and take the quiz now, and when you're ready, move on to the next lesson.